All right. Can you guys hear me? Fantastic. We're just going to wait like another minute or so just to make sure everybody gets on. No video. Well, I have the video off. Can you see me? Fantastic. All right. Well, welcome everybody. This is the first time that we've actually used this technology, so it might be a little bit bumpy today, but I hope that you find this event very informative. I intend to really share quite a bit of information. Some of it you haven't heard before, some of it you may have. But ultimately, I'd like to start off by just kind of introducing who I am and what I do. My name is Bobby Hinkle, and I'm the founder of Main Street Advisors. We're actually a what you might call a family office here in Edmond, Oklahoma, where we help our clients with primarily financial planning, but all of the other elements that go along with that, including investing and insurance and Medicare and taxes and estate planning and pretty much the full gamut. We have a pretty unique offering, but we're actually not here to throw sales pitch at you. What I wanted to do is actually provide you with some very good information, information that unfortunately is not commonplace in our industry. There's a lot of myths and a lot of mistruths that have been pushed on you and everybody else for the last 100 years or so, at least. So, my goal today is to impart enough knowledge to those of you that are watching this that you can recognize what's in your best interests without having to trust someone. That's a big deal. So, as far as the agenda today, what I'd like to do is kind of start off with the 30,000 foot view and then just kind of zoom in as we go. I'm going to cover some stuff that you might know already. So if at the beginning it's a little too simple for you, just wait a little bit. So the first thing that I want to talk to you about is really just looking at the very broad view of the financial industry. Okay. The financial industry, if you were to oversimplify what it looks like, there's really only three client facing entities. There are the broker dealers, and these are the companies, a lot of them that you've heard of: Merrill Lynch, Morgan Stanley, Goldman Sachs, UBS, all of those companies, Raymond James, there's tons of them. And then there are registered investment advisors. Now, we lovingly call these folks RIAs for short, which is, of course, what we are. And then there are insurance companies. Now, my father taught me a great lesson when I was a kid, taught me quite a few, really. But one of those was that anytime you want to know the truth about something, follow the money. Figure out how somebody gets paid, and you'll figure out their motivations for their actions. And it works 99% of the time. And really, there are a number of differences between these types of entities. But ultimately, what I would point out first is how they get paid. A long time ago, broker dealers operated primarily on commissions. A lot of you might be familiar with commissions. Essentially, it's a situation where you go in and you purchase $100,000 of IBM stock, and that financial advisor collects a 5% commission, which comes out of your money. And now that you've done that, you have $95,000 of IBM stock. Registered investment advisors primarily operate on fees, which is typically a percentage. For instance, 1%. of the assets you're managing, which is advantageous for both the advisor and the client these days. But for the client, from the client's perspective, it's because, if the advisor does well and the account grows, then the fees grow. And likewise, if the account falls, then the fees go down as well. Insurance companies also operate on commissions. However, it typically does not come out of your funds. So unlike the example with the broker dealer, if a 5% commission is paid to the advisor, that is paid out of the pocket of the insurance company. However, it's important to recognize that that commission is still factored in to all of the numbers behind the scenes. Now, I think more important to just looking at the fees and commissions and how they get paid, I think it's also important to look at their responsibility to you, right? So broker dealers and insurance companies both use what's called the suitability rule set. Okay, suitability means that as long as an investment recommendation is deemed suitable by the compliance team of the firm, then it is okay to offer it. Whereas registered investment advisors operate as fiduciaries, which means that as long as it is, if the advisor is able to prove that that is in your best interests and deemed suitable for the client, then it is an acceptable transaction. Interestingly, what happened with this whole situation is, it's just a little bit of a history lesson. I won't spend a lot of time on it, but a number of years ago, several decades ago, clients started to kind of figure out that fees were better than commissions. Because with commissions, there's more of a conflict of interest. The advisor's already gotten paid, and whether or not you are successful at that investment is really not as important as it would be to them if they were collecting a fee. So clients started kind of moving away from the large broker dealers and started working with the registered investment advisors. And interestingly enough, of course, the broker dealers have a lot of power, and they said, well, we can't have that. So they became what's called a hybrid, which is what most of them are today, where they're both a broker dealer and a registered investment advisor. Now, of course, when they first did that, they became fiduciaries. And of course, it is actually, you may or may not know this, but it is actually generally less profitable to be a fiduciary. And that's because, and many of you are older and wiser than me. This is not a surprise to you, but generally there is a sliding scale of benefit between the industry and the client. And if that scale is, over in the client's area over here, then that means it benefits the client more and it benefits the industry less. And likewise, if it benefits the industry more, it benefits the client less. This is just a simple fact because there's only so much money to go around, right? Well, let me erase this real quick. And welcome to those who are just joining us. So interestingly, back in 1998, there was a rule passed called the Merrill Rule. And interestingly, Merrill Lynch was involved in the passing of the bill, which is why it was called the Merrill Rule. But it basically said that if you are both a broker dealer and a registered investment advisor, that the broker dealer status takes precedence. Therefore, you don't have to operate as a fiduciary, which of course is more profitable for the industry. It was actually challenged and reaffirmed in 2007. And there's been a number of attempts over the years to create a fiduciary rule. Most of them haven't been terribly successful yet. Anyway, so that's one of the first things I wanted to show you, which is really just kind of zooming in or zooming out and looking at the big picture of, who you're dealing with when you're looking at the financial industry or dealing with the financial industry. This is certainly not erasing as fast as I thought it would. Maybe I need to put a little glass cleaner on it. All right. So the next thing that I want to talk to you about is really, I think, a helpful approach for those of you that don't necessarily have a financial advisor at this point or in the market to look for one. I will do my best not to make this self-serving. I really want to provide you with as much value as possible. I will say that the firm that we designed 12 years ago is the firm that I would look for. But ultimately, that doesn't mean you have to work with us. I want to give you as much value as I possibly can. And the way that I look at this is much like my duty as a fiduciary, is to put myself in your shoes and imagine myself as you. And if I were a client with all the knowledge I have of how this industry works, and I were looking for an advisor, there's really kind of three criteria that I would look for. And this is important. The first one is one that we've already kind of mentioned, and that's working with someone who is a fiduciary. Now, what that means is they have a legal obligation to always do what's in your best interest or face severe penalties. Now, you don't necessarily want to take somebody's word for it either, though. If you ask certain brokers or advisors if they're fiduciaries, they'll answer in ways like, well, we always do what's in our client's best interests, but that's not really answering the question. So what I recommend that everyone do is that you actually go to a website, and it's a government website. Not that government websites are always fantastic, but this is a pretty good one. And it's Advisor Info. It's advisor with an O, which is I'm sorry, I messed that up. It's advisor with an E. So let me fix that real quick. Advisor with an E, which is the English spelling rather than the American spelling. But over on this site, you can actually look up any advisor. Doesn't matter who they are. And there's really two things that you're looking for here. One is underneath their name, it's going to say investment advisor and or broker. If it says broker, they're not a fiduciary. Doesn't matter what they tell you, okay? If it directs you to go to the FINRA website, which is really the regulatory body, kind of like the police of the financial industry, if it directs you to the FINRA website, then they're a broker, pretty much. I will say that there's one other thing you want to look for here, and that is, don't use one again, let's use A and B, is you want to look at the disclosures. And disclosures are if an advisor has ever gotten in trouble, paid a fine, paid a fee, had a complaint, some sort of dispute with a client. I will tell you this though, if you have someone that you've met with and you really trust them and they fit this other criteria I'm going to share with you, and they have a disclosure, well, it doesn't mean you shouldn't work with them. It just means that you want to ask about it. Don't be afraid to ask about it. Just say, hey, because this is a very important topic, picking an advisor. This is something that can dramatically impact your financial future and many other aspects of your life. A disclosure, if there is one on the page, you can actually click on it and get more information. So I'm going to move this out of the way real quick and go to the other criteria for you. The second criteria that I would certainly look for, again, if I were a client with all the knowledge of this industry that I have, is looking for someone who's independent. Now, what I mean by that is that typically when you work for a larger firm, you a lot of times will have a sales manager. You might even have quotas or pressure to perform. You also might have proprietary products. I can tell you in my experience in this industry, proprietary products are kind of an interesting thing. I've never actually seen, not to say they don't exist, but I've never actually seen a proprietary product that was in the client's best interest. Typically, it just means that the advisor gets paid more to sell it. That's just what I've noticed. And so what you're looking for here is no sales manager, no quotas or pressure to perform, and no proprietary products. And you'll have to forgive me, my handwriting is not that great, but hopefully you can read it. The third criteria that I want to share with you is also incredibly important, and it has to do with finding an advisor that has a holistic approach. And what I mean by that is finding an advisor that helps you with more than just investing. And there's a reason that I feel this way. It's something that I've noticed a lot in this industry, is that people will have one or two or three advisors because they think it's a good idea to diversify their financial advisor. That's actually a pretty bad idea. I wouldn't recommend doing that. And the reason why is advisors typically aren't going to talk to each other. And so you have really no idea how much risk you're taking. But more importantly, the advisors that you work with don't really have any idea how much risk you're taking because they don't know what you're doing with the other advisors. But then it goes a lot further. People will have their State Farm insurance guy, they'll have their Medicare guy or girl, they'll have their estate planning attorney, their CPA, all these different financial professionals in their life, and any one of these people can mess up your financial future. In particular, what I consider to be kind of the sacred triangle, which is the advisor, the CPA, and the estate planning attorney. These are people that have a lot of crossover in terms of their responsibility and the activities they do to help you. And so I highly recommend that you find an advisor that can help you with a lot more than investing. But this does sound a little bit like I'm tooting my own horn here, because we are one of the few holistic firms around. But that doesn't mean you have to work with us. It just means that you want to have an advisor that is willing to meet with your CPA, to talk to your CPA, to run things by your CPA, that an advisor that might be willing to go to the estate planning attorney meetings with you. And what this ultimately boils down to is something that's far more powerful for you, something that I refer to as a team-based approach. Hopefully you can see the value in that. I'm going to switch up markers here because I feel like that one's not working. Right? Let's see if I draw some ink out of it. All right. Now, moving on. This part of it, I want to apologize ahead of time for making you all feel like you're going through math class again, but I have something extremely important that I want to share with you. It's really, to be honest with you, kind of a foundation of what we've created with Main Street Advisors. It was something that I noticed working for the Wall Street machine, because I do consider myself a reformed Wall Street broker, that greatly bothered me. But it's something that everyone should be made aware of, but most people aren't. So I'm going to go ahead and see if I can get this technology to work the way that I want it to work here. We're going to do this. And all right. So what we're going to do is a little fun thing here, a little interactivity, because I can't hear anybody. This is my first webinar, by the way, using our new Lightboard technology. But I wanted to see if I could run a poll by you. You know, I like to try to get a little bit of an assessment as to what everyone's acumen is in terms of investing. And so what you have here is two different portfolios or investments, an orange one and a gray one. Now, the orange one is a bit more aggressive, and it's going up 25%, down 15, up 25, down 15 for 8 years. And then you have a more conservative one. It's only going up 15% and then only going down 5% for 8 years. So real quick, I'd like to go ahead and, if you could, go ahead and go to the section that says polls and click on that and just put in what you think. Which one do you think actually outperforms the other? Should I do some Jeopardy music during this? Oh, oh, all right. It's very interesting. I'm not sure if this is skewed because I have a whole lot of our existing clients and existing prospective clients on this webinar. But this is not the typical response that I get, to be honest with you. Right now, we're sitting at 60% saying that the gray, more conservative portfolio outperforms the orange one. When I do this in a classroom setting, in the past, prior to COVID, which we will get back to, and that's really what we're trying to do here, is a classroom setting that doesn't require you physically going to a classroom. Normally, it is the orange portfolio that wins, and that's where it looks like that's what we're at now. It's now 60-40. So I'm going to go ahead and move on from waiting on the poll. But what you have here is a very interesting phenomenon, in my opinion, and that's that most people believe wholeheartedly when they see this more aggressive portfolio that it outperforms the other. And that's because you've all been taught a concept. It's a concept that is incredibly well known. This concept of risk and reward. I'm sure you're all familiar with it. The idea is that the more risk you take, the more potential reward that you have. And I can tell you right now that that's not true. It is true in some situations. Well, the highest risk investment you can make is a business, which is the highest rewarding. But it's not true in a lot of cases, because what you're going to find out real interestingly here is that the aggressive portfolio compounds 27.4% over these 8 years, and the conservative one compounds 42.5. It's a pretty dramatic difference, wouldn't you say? Now, also very interestingly, I'm going to move on here. I want to talk about a little bit more about the, forgive me about my lack of familiarity with this technology. There'll be a few hiccups here and there, but I want to talk a little bit more about this. Really what it boils down to is how the math actually works. When you look at, and you take a closer look at a word that you guys are all familiar with, it's the word compounding. Of course, Albert Einstein famously said that it was the most prolific invention in all of human history. I'm not sure if he actually said that, but it's a famous quote. And ultimately, when I heard that quote, I actually started thinking about it, and I was like, maybe I don't understand compounding, because why would he say that? I mean, he could have said a lot of things. I mean, physics was my favorite class in college, and we could talk about the theory of relativity all day long. It's fascinating stuff. So why would he say compounding? And so I started to study it, and I realized that I did not understand compounding. And I would say that most people do not, frankly. And in fact, sadly, I would say most financial professionals do not understand compounding. So let me just reveal some things to you that are very, very helpful. And that's that, when I first started to examine compounding, before I really fully wrapped my mind around it, I had this, I guess, predisposition that positive compounding and negative compounding were equal forces. I mean, if you think about compounding like a snowball going down a hill and it just grows and grows and grows, you would think that it really does the same thing, whether it's going up or down, accepting gravity, of course. And what we found is that negative compounding is actually far, far more powerful than positive compounding. They are not equal forces at all, As an example, there's a very simple mathematical truth as to why this is the case. And it's simply because anytime you are experiencing negative compounding, you're going from a higher number to a lower number, right? And anytime you're experiencing positive compounding or making money, this is losing money in case you're not familiar, and making money, you are going from a lower number to a higher number with positive compounding. So just to illustrate what I'm talking about, if you had, say, $500,000 invested in something, and you had a great year, and we made 25%. So now we're up to $625,000, and we're feeling pretty good. But then the next year, we're going to go down 25%. So keep in mind, we went up 25, and now we're going down 25. Well, now you're actually at about $468,000. That's not exact, but it's head math. And so you're below where you started, and it's just because of a simple mathematical truth that I'm sure is making sense to nearly everyone on this video, and that is that when you have a percentage movement based on a higher number, you have the resulting number is greater, right? So this is very important to recognize, is that this always happens. It's a law. Anytime that something is going down, it has a greater impact than when it's going up. Now, a lot of you probably are familiar with this concept. Some of you might not be. But it's important to wrap your mind around this, because interesting truth that I want to share with you, which is really the foundation of everything that we do here. And it's that in this business, and not just in the advisory business, but if you're watching CNBC, or if you're watching Bloomberg, or if you're listening to some financial commentator, or reading a newsletter, or looking at investments, or talking to an advisor, or looking at a financial plan, working on a financial plan, you're going to see a word over and over and over and over. And this word is a very important word. We're going to spend a little time talking about it. And it's the word average. Now, the truth is that averages really kind of don't exist, except to sell you something, because you are never going to earn an average. In fact, if you have the ability to have negative compounding, if you have something that can lose, then you are always going to underperform the average over any extended period of time. So going back to this slide that I was showing you earlier, if you'll notice up here that both of these portfolios, despite having I'm going to make it full screen for a second, despite having a very different end result of 27.4% and 42.5%, both of them have an average return of 5%. Isn't that interesting? I mean, if you think about it, every time you've ever looked at a mutual fund, it'll have the 1 year, 3 year, 5 year, 7 year, 10 year average. Or they'll say, if you're being sold something, they'll say, well, this portfolio average is 8%, or the market average is 7%. And you hear all of these things. Well, I can tell you that the first time that I started to stumble upon this interesting truth, it was not related to the math. It was that when I was going through training at the Wall Street firm that I used to work at, I thought it was baffling that most of the time we spent in training was on retention, how to talk people out of leaving. And of course, I thought to myself, why are we spending so much time on this? I really would much rather learn about investing. I don't want to learn about how to talk people out of leaving the firm. And of course, this is talking clients out of, firing me as an advisor. And it wasn't until I learned this math that the light bulb finally went off for me. And I was like, okay, I get it. This whole industry is designed to overpromise using averages, underdeliver because of what actually happens with compounded averages, and then talk you out of leaving, rinse, and repeat that. So let me just show you some more about this, because I know sometimes this can be a little bit confusing for some folks. All right, so we're going to pull up this little chart here, and I'm going to try and stick myself down here in the bottom. I'm going to get some of this drawing out of the way. Now, what you see right here is the Dow Jones for 120 years. And I love long sample sizes because you get more data out of it. And so this is 120 years. The top left is 1900 and the bottom right is 2019. So 120 years of the Dow Jones. And, interestingly, it does indeed average 7.4%, as you can see right there. So they're not lying when they say that the market average is 7%. However, it's very important to recognize, and I can't say this any stronger, it gives you zero indication as to how you would actually do investing money. None. You could actually have a negative number and have a high average. I'm dead serious. I'll show you the math. What you have here is, again, 120 years. I'm going to make this bigger so I'm not in the way. Now, here's the interesting part. If you took real money and ran it through this 120-year sequence, and you didn't pay any fees to anybody, and you didn't have any managers causing underperformance, you had exactly these performances every year, you would have an annual compounded return of 5.2%. Now, that is a dramatic difference. In fact, over this period of time, it could be the difference between 400,000 and 4 million. It's a giant difference. And so I want to, kind of just trail off a little bit. This isn't a scripted thing, but I want to talk to you a little bit about the importance of reading your statements properly and your financial plan. We're all trained to look at the annual percentage return. That's what we do, right? You pull up your 401k and you're like, well, what's my annual percentage return? Interestingly, that's actually the third most important number. The first most important number is the number that you are compounding. In other words, your balance, your principal. Now, what I'm really illustrating here is how to get a better return. Okay, to get a better return, first you focus on the number you are compounding, but I'll spend more time on that. The second thing is the frequency of compounding. Okay. Now, what that means is the interval, or how often you compound. Is it monthly? How many months? Is it daily? How many days? And then third is the annual percentage return. Okay, so moving on, for the sake of time, This could very easily be a 4-hour lesson, but I'm not going to make it a 4-hour lesson. We're going to do 1 hour. I promise. I'm going to do my best. All right. So here's some examples just to kind of help hammer this home. Let me see if I can get this moved over so that I can be in the picture. All right. So what you have here is examples. The first one over here is case A. All right. This is very easy. So over a 3-year period, you earn 5%, 5%, 5%. Well, then you have an average return of 5%, and you also have a compounded return of what you actually made of 5%. Right? Simple. Now look at case E. For the sake of time, we'll just skip to case E. And in the first year, you have a great year. You earn 30%. You're feeling pretty good about it. The second year, we're going to go down 25%. It is very important to recognize that you're now negative. You went up 30 and down 25, but it's 25% of a greater number, right? The third year, you're up 10%, and you still have an average performance of 5%. And it might even be presented to you like that, sadly. But you only earned 2.3% per year. Or case F, up 40%, down 35%, up 10%, still have an average return of 5%, but you didn't really make anything over that 3-year period. Interesting, don't you think? I know you can't answer me, so it's automatically rhetorical, right? Sorry, I've got a pretty weird sense of humor. All right. So that was the end of that slide section. So I want to go through, with the last bit of time that we have here, I want to go through and just kind of talk to you about some stuff that you may already know, but I'm going to point it out in a different way than you've seen it before, and kind of an approach that I would say is better. Now, this is an approach that we use here at Main Street Advisors, but it's also an approach that you can do on your own. And so I really want you guys to pay attention here. So the Wall Street method of investing could be referred to as modern portfolio theory. Modern portfolio theory could be oversimplified and be referred to as a word I know you guys have heard a million times: diversification, right? You've all heard that. I keep asking you guys if you're hearing me, and I can't hear anything. I know you're there though. So diversification, right? Why do we diversify? Well, I would say that primarily it's to control volatility, right? Or to prevent losses to some degree, but secondarily, I would say it's to gain access to investments that you might not otherwise be exposed to, right? But this might seem a little complicated, but I assure you it's not, and it will make sense. When you really get deep into the weeds, and we're not going to get deep into the weeds, you learn about the Greeks: alpha, beta, theta, rho, vega. These are all things on how price is affected by different things. But there is one that I like to talk to everybody about. I think it's important that everyone has an idea of what beta means. Now, the way that Wall Street uses beta, I don't totally agree with it. Typically, when you see an investment that says beta, it's giving you an idea of how it moves in respect to the S&P 500. When in actuality, if you boil it down, beta is the same thing as the word correlation. Meaning, how does something move in respect to something else? Well, you can take any two assets and you can actually come up with what's called a correlation coefficient, okay? Sounds complicated, but it's really not. It doesn't matter what it is: a stock and another stock, a stock and a bond, a piece of real estate and a business, okay? If it is possible to come up with a correlation coefficient between these two assets. A -1 means that it moves in the opposite direction. A +1 means it moves in the same exact direction, okay? A 0 means it's got nothing to do with it. It's kind of the holy grail of diversification. Now, I will say that you guys are all familiar with the meat and potatoes, right? The meat and potatoes of investing are stocks and bonds. And in case you're not terribly familiar, stocks are when you own something, and bonds are when you are loaning something. So you can think about it like that: own and loan. But traditionally, we are taught, and we've been taught this for a long, long time, that the correlation between stocks and bonds is on the negative side, somewhere over here, right? Maybe like -0.85. And what that means is that the price of stocks and the price of bonds are supposed to be moving in opposite directions. And that's why it makes sense to diversify, right? The problem is and most people aren't aware of this, is how bonds work. Bonds work like a seesaw. Oh, I'm drawing off the side here. Let me scoot that over. Like a seesaw or a teeter-totter. On one end, you have the price of the bond, and the other end, you have the interest rate or the yield, right? And almost 40 years, okay, almost 40 years, the longest really anything's gone in one direction before, interest rates were going down, right? There was a few blips here and there, and that meant that the price of bonds were going up. Drawn off the side again. Well, what happened in 2022? Well, in 2022, of course, the Federal Reserve comes out and starts raising interest rates. And what happens is that all the bonds that currently exist start losing their principal value. Think about it like this. Let's say you go buy a 10-year treasury a year and a half ago for 3.2%, all right? And now you're looking at the 10-year treasury at, say, 4.2%. And you're like, you know what? I really would like to sell that 3.2% bond and buy the 4.2% bond, but somebody has to be willing to buy it from you. Every trade has a buyer and a seller, and every trade has a winner and a loser. Money doesn't disappear, it changes hands. And this buyer of your 3.2% bond is going to go, well, why would I buy your 3.2% bond if I can buy a 4.2% bond? Right? This is an illustration to you, a microcosm of how the bond industry or the bonds as an asset class lose their principal value. Now, what's interesting is I started to notice back when I was still working for the Wall Street machine that there was a positive correlation happening between stocks and bonds. And of course, I asked my trainers and I asked my people that I looked up to there as far as knowledge base, and their answer was, well, it was because of the stimulus. All the stimulus from the Federal Reserve and the Treasury Department, which is now standing probably well over $18 trillion today, which is a staggering number, by the way. I'll spend some time on that if we had more time. But what I noticed recently, and this is really important, is I saw a chart. I might be able to pull it up on the screen for you. No, I don't have it available. But basically, it was a chart. Happy to show you guys if you reach out to me later. And it was from 1926 to 2022. So almost 100 years of data. And it was like a graph chart, okay, like this, like a quadrant chart. And it had stocks and bonds. And it had all these years plotted, just all over the place like this, right? And down here in this lonely quadrant was 1931, 1969, and 2022. 2022 was one of the worst years on record. It was the worst year on record for the bond market. It was the sixth worst year since 1926 for the stock market. 2009 was the second worst year for the bond market. But the reason I'm showing you this is because I got something very interesting out of it. I know you probably already think that I'm not a huge fan of the Wall Street machine and how it works. I mean, the truth is, I believe it is a vehicle designed to siphon money off the middle class and give it to the institutions. This is a mechanism for doing that. Because the truth is that over this almost 100 years of data, only 36.5% of those years did stocks and bonds move in opposite directions. So it's not a symptom of stimulus alone. In fact, just to kind of give you some more insight into what I just said, I know it makes me sound like a conspiracy theorist, but you can draw your own conclusions once I share the data with you. But you guys are all, I'm sure, very familiar with what I'm about to draw on the board. I'm gonna have to figure out a way to get this to erase faster is what I'm gonna have to do. Okay, that's good enough. So everyone's somewhat familiar with this because this is the Wall Street approach. You see it all the time. They have these 5 risk tolerance categories, right? And anytime you meet with an advisor or a firm, they're going to try and figure out which box you fit into. You've got aggressive, moderately aggressive, moderate, moderately conservative, and conservative. I'm sure this is looking familiar to you. And really what that ends up looking like, because almost every firm out there uses this, we don't, but almost every firm does. And that's that if you're a moderate investor, you might have 50% in stocks and 50% in bonds. If you're moderately conservative, well, you might have 40, 60. And if you're conservative, you might have 15% in stocks and 85% in bonds. Then it goes the other direction. Moderately aggressive is going to be a 60%, 40%, and aggressive 85, 15. This is a system that's been around for a long time. But it's kind of interesting when you really zoom out and think about what this means. You know, they teach you that bonds are the safe asset. And of course, for a long time, stocks and bonds were moving up together. Nobody was complaining about their correlation not being what it was supposed to be until 2022, when both stocks and bonds went down together. We're going to see more of that, by the way. But what you see here is an asset class that they teach you is a safer asset class. But we already know, if you remember, the teeter-totter seesaw on how bonds work, right? As interest rates go up, the price of bonds that currently exist lose their principal value. Well, what do all these financial planners and advisors recommend as you get older, right? You should be moving this direction towards conservative, right? Which I do agree with that by the definition of these words. However, I don't agree with this methodology, which is as you get older, you would be loading up more and more into an asset class that is very vulnerable and not well understood by most of the investing public. You know, I think it's a very important thing to be aware of. So I have actually, I'm going to try this. See if I can get it real quick. Oh yeah, that's much better. So we've come up with a different approach that I can't take all the credit for it. A lot of the stuff that we do, I kind of took the best of what I found out there, the best stuff for clients, and designed a firm around it. There's a few things that I can take credit for that I designed myself, which we can talk about individually if you'd like. But I will say that I think that this approach is a lot simpler and a lot more effective. If I were to give you a job description, I would say that I am a risk manager. It is my job to identify the different types of risk to my clients, quantify how much of each risk they're exposed to, and then come up with a plan to mitigate or eliminate those risks. Now it's left a haze on here. I'm not even sure if you guys can see this haze or not, but I'm just going to give it another wipe. All right. And so looking at everything from a perspective of risk first, if you're wanting to control risk, rather than using this 5-bucket approach of moderate, moderately conservative, and so on, there's a simpler method, and it works very well. And it's to think about anything you own, it doesn't matter what it is, and it will fit into one of these buckets. So if you look at something you own and you say, can this lose money? It can. Okay, then it goes into the at-risk bucket. And in our software, we color it red. That's not working. You'll just have to read the word. We call it red money for ease of understanding. And then if you look at something else you own and you say, can this lose? No, it can't lose. It's guaranteed not to lose, or it's extremely unlikely to lose. It goes into the green bucket. Okay. And then we have also incredibly important emergency funds. Now, hopefully you can see, we color this blue, by the way. Hopefully you can see how this is more effective because it allows you to control risk on a guaranteed basis rather than an I hope so basis. As an example, you know, let's say that you consider yourself a moderately conservative investor based on the traditional methodology. Well, if you look at your estate or your liquid net worth as a pie, right? Well, we want to have somewhere around 3 to 5% in blue money. And this is for a typical, $500 to $1 million liquid net worth. $500,000 to $1 million, because these percentages change depending on the size of your estate. And then you might have, let's just say 40, my drawing is so good, isn't it? I'm just gonna color it in. All right, and you might have, let's say 45% in green money, money that isn't going to lose. And then of course, what do we have left? We've got 55%, assuming that's 5%, in red money. Now, what you have here is a situation where you have reduced your possibility of loss, assuming that you would normally just keep the emergency funds. Those are always going to be there. But you've reduced your possibility of loss by 45%. And if you remember when I was talking to you earlier about negative compounding and the power of it, I'm going to pull this slide back up right here and show this to you. A lot of it's very interesting, because the truth is that that's not working. I'll just keep myself off of it for now. But you can see that it's actually an exponentially moving target. What you've got here is the losses on the left side, 5%, 10, 15, 20, 30, 40, 50. And what it actually takes in terms of a performance, a percentage performance, just to break even, just to get your money back, right? So if you're down 15%, it takes 17.6% just to get your money back. If you're down 40%, it takes a 67% return to get your money back. I know this can sometimes be a little confusing, but usually everyone kind of gets the last one. And that's if you get $100,000, you lose 50% of it, you're down to $50,000. What percentage of 50,000 do you need to get back? Well, you need the whole thing. Right? Now, it gets really ugly when you get past 50%, but it's an exponentially moving target. So if you can imagine taking some of your money and putting it in a situation where it cannot lose, it actually increases your probability of success. However, when it comes to risk, there's really kind of two thoughts. There's risk tolerance, which is what everyone's familiar with. That's what I refer to as risk willingness, how much risk you feel like you should be taking. Unfortunately, most of the industry just bases everything they do off of just your feelings about risk. But the truth is there's also risk capacity, which is how much risk you should be taking or could be taking. And the only way to actually really determine that accurately is to do a financial plan, a cash flow analysis, which shows you what every month of every year looks like going forward, or some projection that you can conservatively project the future and see exactly how your cash flow goes. If there's a red line, if you run out of money at some point, well, that's going to create a situation where you have less risk capacity, right? Forgive me. So, of course, a lot of people will ask me, like, how do you do that? How do you separate your assets into those boxes? So again, going from the 30,000-foot view and drilling in, I will show you what I do. And I recommend that everyone do this, because I do believe in diversification, just not in the traditional sense. I think it's important to more broadly diversify. And what I mean by that is having different asset classes that do not have a correlation to each other. Okay? Now, I want to give you a little bit of a preface before you see this. A lot of people have predispositions. They have feelings about asset classes. There's buzzwords, right? Buzzwords like annuity or reverse mortgage. These are things that people hear and they're like, oh, those are bad. The truth of the matter is that there's a disease in the sales business. And that's anytime a salesperson doesn't have something, it's bad, right? Go to a Cadillac dealership, mention Toyota while you're there. What are they going to say? They're going to say, well, Toyota's not a good car. You don't want a Toyota. Toyota's a good car, but they don't sell Toyotas. It's the same thing in our financial industry. If you go to the guy that works at the Wall Street firm, he'll say, stay away from annuities, stay away from real estate. You go to a guy that's doing the real estate seminar and trying to get you to buy rental properties, he'll tell you stay away from stocks and bonds, they're bad. It's the same thing across the board. The way you should analyze it, because I want to equip you with how to analyze things. For one, I showed you the math, the compounding return versus the average, right? So when you're shown a sales pitch regarding an investment, it equips you with the ability to ask and understand, well, what would I actually earn on this? And if the advisor's like, well, it's the 7% average. Well, then they don't understand the math. And frankly, most advisors do not understand the math because the industry doesn't want advisors to understand the math, just like they don't want you to understand the math. I mean, if you think about it, it's a lot more attractive. If I show you two investments, one's 7.4% and one's 5.2, but I don't tell you anything about them, which one do you want? Right? You want the higher one, always. And so the whole industry is based on the whole sales approach is based on using averages, which you will never earn. Now, I would recommend to everyone that you examine all of your options and you examine them by looking at their own merits, not having predisposition at all. And the way you do that, honestly, is by focusing on the cons, not the pros, right? Because every investment has pros and cons. But the cons are far more important. That's what you should focus on. Because if you want to build a portfolio of pros, it's easy. You just throw them on the wall and they stick. However, if you want to balance the cons in a portfolio and you're able to do that, then you're able to create something fairly magical. As an example, I know all of you guys came here to learn. I'm getting off track. I'll come back to the assets. Everybody here came to learn about the perfect investment. So I'm going to share it with you now. Everybody ready for this? Hope you're sitting down. This is the perfect investment. It's something that is 100% liquid. You can take your money out of it whenever you want to. It gives you a substantial return on your investment. We all want that. And it's 100% safe, right? I'm sure a lot of you already know this doesn't exist. If it did, I probably wouldn't have a job. I'd be investing in this, and so would everybody else. The reality is that you can build this by balancing the cons. Think about it this way. Throw any asset at that, and you'll see that it's good at one of them, not very good at the second one, and maybe terrible at the third one, right? A bank account, 100% liquid, it's not going to give you a great return. Safe from everything except inflation, unless you find a rate that's higher than the inflation rate, which is rarely the case. Right now, you can, if you go to some, credit unions and smaller regional banks and stuff like that. There's some bank CDs out there that fit pretty well. Bank CDs, not as liquid as a bank account, can give you a little bit better return. And again, I consider it very safe. That is green money, okay? An insurance product. Now, when it comes to insurance products, I will say that I'm pretty biased about it from one perspective, and that's that there's really kind of two different fields of insurance products. There's the variable kind and there's the fixed kind. And variable simply means that you can lose money. Well, if you're going to take the risk of loss, just buy securities and pay less money in fees. I've never actually seen a variable insurance product that I liked a whole lot, because there's better alternatives. But a fixed insurance product, it's not as liquid. It's not a liquid product. It can give you a pretty decent return, but not a great return. And it's considered pretty safe. An account at Charles Schwab or Vanguard or some investment account somewhere, it's 100% liquid. You might have to pay taxes on it if it's an IRA. You can have a great return, but it's not very safe. A rental property, it's not liquid at all. It can give you a good return. And if you buy the right kind, I consider it very safe. We can spend more time on this if you individually want to meet and kind of go over some of these concerns and questions that are formulating in your minds at this point. And I'm almost done here. I won't take up too much more of your time. But the way that I believe you should diversify is by looking for as many asset classes as you can fit that make sense for your financial plan. Now, a real true fiduciary is not going to recommend products to you based on the product's characteristics, but how the products actually fit like puzzle pieces in a greater picture. And each thing has to serve a purpose, whether it's creating income, protecting assets, battling inflation, being very liquid, being an emergency fund. There's a place for everything. So what we do is we lump everything that's traded on the exchanges into one category. We call it securities. We run our investment strategies in-house. I'm happy to talk to you about that sometime individually. That is our registered investment advisory firm. But we also recommend taking a look at things like commercial real estate. And when I say that, I'm talking about actually buying real estate, not a real estate investment trust. That's also a security. I would say that right now, Caveat is I don't think it's a great time to buy commercial real estate. There's some risks there that we can talk about another place. There are alternative investments. These are things that can create tax deductions. My screen just went black. Hopefully everybody's still there. And then also perhaps investing in businesses. On the green money side, we take the best of the insurance world, and there are some pretty fantastic products out there. There really are. We look at bank CDs, which are now starting to become more attractive. Multi-year guaranteed annuities. Those are the same thing as a bank CD. They're just issued by insurance companies. They're paying close to 6% right now. And then, of course, one that I like a whole lot, and that's low-income rental properties, which we do for our clients as well. And I can tell you that most of my clients don't own them because they don't want to be a landlord. But there is a lot of, and the reason, let me clarify why I put low income. If you buy a rental property that's $3,000 a month in rent, and we go through a deep recession, it's possible you might be without a renter for a bit. However, if we go through a recession and your property's $800 a month, you're more likely to not have any lack of renters. In fact, you might even have more demand than you had otherwise. The downside, because again, everything has pros and cons. The downside here is not only is it not a liquid investment, and generally speaking, green money is not, but it also requires work, which is why most of my clients don't own them. I bring it up every time, but ultimately, you have to be willing to be a landlord. And what that means, being a good landlord is not being a good landlord from the tenant's perspective. It's being a good landlord as a business owner, which means that you're willing to raise rents. It means that you're willing to evict someone if you have to. It means you're willing to fix things when they're broken. That's hard to do. I'll be honest with you. I think most people that are friendly, easygoing people, especially a lot of people here in Oklahoma that I know well, they're just sweet souls. And it's hard. It's really hard to do that. And you've got some little old lady renting a house from you for 7 years, and you're like, I really don't want to raise rent on her. But you want to try and make sure you're getting market rents for that. Because reality is that you can get a pretty solid return the way we're targeting. And unlike an insurance product, it's actually going to go up in value over time. Whereas an insurance product might pay you a little bit more income, but it's going to go down in value over time. But then you have the pros and cons of actively involved and passive, right? So these are all things that each one of these is like a puzzle piece that has to be fit together. And then, of course, on the blue money side, we have cash, which is very simple and also incredibly important. And so not only does this allow you to control risk in a way that's predictable and certain, but it also is about layers of liquidity, right? Because you can get this money in your hands in 5 minutes. You can get this money in your hand generally in 1 day. It depends on the asset, obviously. And some of these, by the way, alternative investments, a caveat I have to put this out there is that there are rules that the government has. They're not my rules, but I do follow them, that you have to be an accredited investor or a qualified purchaser to invest in certain asset classes. We can talk about that individually for each of you that want to meet and talk about this stuff. So moving on, and we are getting very, very close to the end here. I wanted to actually just talk to you lastly about our financial planning process. We actually went through the trouble of getting it trademarked because I wanted to design a financial planning process, and financial planning is often underappreciated. And that's because truthfully, most financial plans are just a sales tool. It's just something for the financial salesperson to convince you to buy something or sign up for something. We wanted to create a financial plan that could be used as a roadmap, whether you do business with us or not. And so that's one thing, that's the call to action here, is to encourage you guys to use us to do a financial plan. We do not charge for our financial plans because we really purposefully try not to have any sales pitches in our meetings. The closest thing to a sales pitch that we have is the financial plan itself. And we build our financial plan in a very unique way. For one, I will tell you that we build it in a way that we can realistically try to predict the future, because everyone knows you can't predict the future. But what we do is we build it so conservatively that we know As an example, we will underestimate cost of living adjustments for Social Security and for pensions. We will use compounded weighted returns on all of the asset performances, which is, if you were here at the beginning, a very important part of what we do. And then on the expense side, we individually itemize all of your expenses, and we put individual inflation rates on each category separately and just kind of overinflate them a little bit so that we can realistically project what your expenses look like in the future. Now here, this is really important. Expenses are the most important ingredient in your financial plan, but advisors don't spend time on expenses because, newsflash, they don't get paid to manage your expenses. But it is the most important ingredient. Okay, so that some time needs to be spent on that. And that's generally the hardest part for most people, because a lot of people just aren't used to doing it, but we found a way to make it easy. And then lastly, we overestimate your taxes by trying to figure out what your taxes look like going forward. But what we do is we put in a rising tax rate environment because we feel pretty confident that's going to happen. And if you have all of those conservative elements in there and the numbers work, then you know you have a plan that is relatively bulletproof. And so our Prosperity Blueprint that's the name of our financial plan. And what's different about the planning process, in addition to not really having any sales pitches outright in it, we really try hard not to do that, even though there's sales involved in everything most people do, is that normally financial plans have some sort of a discovery session. Almost everybody does that, where you learn, and I misspelled it, that's funny, where you learn about the prospective client and gather data, right? We start with education, which is what we're doing right now. Okay, and then we have the discovery process, and then you have the plan presentation. And interestingly, that's where the financial planning process typically ends with most advisory firms, is here's your plan. Isn't it wonderful? You ready to sign up? But in my opinion, that's not a great plan. And that's because it's something designed by a planner or an advisor without your help. And so where our process deviates a great deal is we have another meeting after that called the plan participation meeting. And this is when you've had the first draft of the financial plan to look at and analyze and come up with questions and concerns, things you like and things you don't like. And in this meeting, we actually spend all of our time on the plan participation meeting going over these questions and concerns, things you like, things you don't, things you want to understand more. Maybe you want more over here and less over there. And so in this meeting together, we come up with a second draft. And now it's something powerful because it's something that we've created as a team. And then we have another meeting. We call it our decision meeting. And yes, I'm spelling badly because multitasking is not my specialty. In our decision meeting, we get together and we go through and make sure you completely understand recommendations. We're not going to let you move forward with anything unless you do. But we'll make last minute changes to the plan, make sure we caught any errors that we may have put in there, and come up with a third and final draft of the financial plan. And then simply, we just ask you if you want to schedule an onboarding meeting and become a client or part ways as friends. Hopefully you find that really fair. Hopefully you found today's presentation very educational and informative. There's certainly a lot of information that I'm happy to share with you in addition to what we talked about today. But I would encourage each and every one of you to take advantage of this complimentary process of getting a real financial plan in place. And again, it does not require that you work with us. It does not require that you become a client of ours, and you will get something very valuable out of it. So keep in mind, there should be, let me just take a look real quick. I got to get this out of the way. So there should be over here on the offers section, you'll see where it says schedule a call. And really what that button should do is take you to our calendar. It's actually my calendar. And you can see right there, I'm going to pull it over to this screen so you can, no, I can't, it won't let me do it. Well, maybe it will. Yeah, it does. Where you have discovery call and also financial planning meeting. So if you click discovery call, that allows you to schedule a 15-minute phone call with me where we can just kind of get to know each other and talk about your concerns and questions that you have, any advice that you're looking for immediately. And then of course, if you are interested in starting the financial planning process, you can actually click the financial planning meeting right here. I will tell you that we spend a lot of time together. Typically, our meetings are 2 hours each. I know that seems a little intimidating to some folks, but this is very important information. This is not something that you should fly through. And so we're typically spending 2 hours here, 2 hours here, and 2 hours here at the very least, and also here. So most of our clients spent about 8 to 10 hours with us before we ever decided to work together. This is an important topic. It's not like getting a bad car salesman. You know, finding the right advisor is incredibly important for your financial future. So anyway, I want to thank you all for attending our very first educational webinar. I know there was some hiccups, but hopefully you got some really good information out of it. And I look forward to speaking to you guys in the future. Thank you so much.